Welcome to the Capital Ratio, where Skadden explores the dynamic world of financial institution regulation, offering insights for institutions navigating the regulatory environments in the UK, EU, and US.
Hi, and welcome everybody to the next edition of the Capital Ratio. I'm your host, Sebastian Barling, a partner in the Skadden's Financial Regulatory Group. And today we have a guest speaker. Chris Rich is joining us, and he's the GC of the Financial Market Standards Board. With him, we're going to look at some of the work the FMSB has been doing to identify some of the future trends that are likely to impact financial markets over the next decade. But before we get into that, and for those of you not familiar with the FMSB, I'll ask Chris to introduce himself and talk a little bit about what the organisation is and what it does.
Well, Seb, thank you very much. I'm delighted to be here, and the time of this conversation is perfect. So on Monday, we had our 10-year anniversary of the Fair and Effective Markets Review. Gave birth to the Financial Market Standards Board a decade ago, and it was conducted by the FCA, the Bank of England, and HM Treasury in light of serious instances of misconduct in wholesale financial markets, in particular the LIBOR and FX scandals. And the goal really was, and this was very much driven by Mark Carney at the time, who was governor of the Bank of England, to put greater responsibility on market practitioners for conduct in wholesale markets. The organisation's overarching goal is to drive improvements in standards of conduct. And within that, there are four core objectives. So the first is to think about horizon scanning. Where might risks or vulnerabilities come from in wholesale markets, and practitioners being in a better position to or in a particularly privileged position to think about where risks might emerge from on their desks or instruments that they're trading. The second goal was to look at ambiguities in existing market practices and shine a light on those ambiguities and seek to clarify or amend or set standards in relation to those areas of market practice which were perceived to be ambiguous and perhaps over time could become problematic. The third goal was to drive adherence to standards, and we do that through an attestation mechanism. So every member signs an annual attestation saying that they comply with the standards. And fourthly, to drive international convergence of standards. Global markets are global. The clients that are being served often have global footprints, and so to the extent possible and working within existing legal and regulatory frameworks, trying to have consistent standards of practice around wholesale conduct issues.
Thanks, Chris. And then what are some of the key publications that you've issued to date that people are now kind of using in the market as their standards?
So we've put out, I think, 11 standards and about 15 or so statements of good practice. I think to highlight some of the key ones, we've done a lot of work around large trades and pre-hedging, and now the large trades work that we did sort of sets the international standard around the management of large trades, the disclosure in relation to the execution of large trades. We've also done work in the new issuance space, around conflicts of interest and other areas.
Great. Thanks. And then that's clearly coming out of the kind of standard setting part of the business. And we saw the publication that you guys have just put out, the Future of Financial Markets. Clearly that comes out of your horizon scanning kind of remit, looking at things that people need to think about over the next decade or so. And having read through this, it's clearly a pretty substantial document. Could you just let us know like how long you've been spending on all of this, who's been involved?
Yeah, so I mean, this is it was a fascinating exercise to undertake, and we started this in the early part of the summer and interviewed or received input from 60-odd firms and individuals around the world, from Dubai, from Hong Kong, from London, from New York, from many of the global financial centres, and tried to engage as broader set of actors within wholesale markets as we could. So you've got the traditional sell side, the new liquidity providers, some of the firms that are very active in private markets, the traditional asset managers, and then some of the platforms and data providers within the market. So it does really seek to capture a broad set of views. And what we sought to do was translate those diverse set of opinions into a document which lays out both how the market has quite fundamentally changed since 2015 to now, and then where do people think it's going to go over the next few years in light of the trends that we've seen?
I think, Chris, that's a really good point. The fact that this is looking at the post-GFC issues, given that those have largely been digested by a lot of the markets. And within the document, you identify 4 key drivers of change, both over the last 10 years, but also those that you potentially see trickling forward in the future. And running through the 4 of those quickly, I mean, there's societal trends such as aging demographics and climate change, which I don't think anybody is going to disagree is going to continue to be a concern for people. It also identifies geopolitics, and people know we've been in a world of higher inflation and potential pressures on the historic move towards globalization, whether that continues. I mean, tech, I think everyone expects to see here, the endless march of tech is not going to be changing, but again, you pull out the particular use of AI and distributed ledger technology, as well as regulation over the last few years and how that has been increasing to capture both new markets, but also looking at improving things like operational resilience and transparency around those markets. Given a lot of this is looking at what's going to happen in the future, kind of those trends, do you think any of those are going to die off, or any of those are going to become more acute?
I would start with regulation. We've obviously seen a period of very significant regulatory change post-GFC. I think we're coming to the end of, or we've perhaps reached a high cyclical watermark of regulation. Mm-hmm. And certainly, as you know, that the message from regulators and central banks around the world is changing, and there is much greater emphasis on the competitiveness of national financial centres, of economic growth, and seeking to strike the right balance between that and traditional regulatory concerns around investor protection, around stability and other things. So I think we are likely to see, at a minimum, regulatory simplification, and perhaps a move to, in some places, an unpicking of specific rules that may not be sort of central going forward.
Thanks. I think that's certainly consistent with some of the stuff we've seen, with an increased look towards regulatory competitiveness and regulatory arbitrage, particularly with new financial centres kind of cropping up outside of the traditional hubs. And I'm sure we'll talk about those a little bit later. Looking at the themes that you've identified, you've sort of taken those and then you've looked at how those will then impact the financial market in, again, another kind of 4 broad headings. So I think the first one the report picks out is looking at market participation and how those trends will potentially impact how that develops in the future. What's interesting is the report looks at those 4 large trends that you see continuing to develop and has picked out 4 themes that you see impacting financial markets kind of over the next decade. And we'll talk about all of those in turn, but the first one that you guys have pulled out is market participation and how that is likely to change. And in particular, you identify how prop trading houses are becoming more important. There's consolidation that's been happening on the buy side. There's been a large rise of private credit. We've certainly seen a lot of that kind of here at Skadden's. But what do you think these trends mean for the future, and how are those going to continue to develop?
The way that the market and the participants in the market have changed since 2015 is quite marked. And as you say, I think those 3 areas, and I'll expand on them in a moment, are sort of key areas of development, which have happened, but I think are also likely to continue. So the first one being, the proprietary trading firms, and their growth in part in response to client demand, to greater levels of specialization within the industry, and also in part, a reflection of the post-GFC regulatory environment, the Volcker rule, and other things that move proprietary risk-taking out of the banks and into some of these new entities. So they have grown from, we've grown from a very much a traditional dealer-led market, say in 2015, to one where in data-rich liquid asset classes, the proprietary trading firms are very significant players. And I think looking forward, certainly the view of the people that we spoke to in conducting this exercise was that trend is likely to continue, and indeed the proprietary trading firms perhaps will expand their presence from the most liquid data-rich asset classes to slightly lower down the liquidity spectrum and into credit, which we're already seeing, and sort of a broader focus on fixed income.
So effectively, we're looking to see their significance potentially increase beyond the already relatively high amount of significance they have in certain markets.
I think that's right.
We've certainly acted on a lot of deals here at Skadden's, which falling within the broad bucket of buy-side consolidation, as we've seen a bit of integration in that part of the sector. Do you think that's going to continue?
Yeah, so when we think about buy-side consolidation, I guess on the, within the traditional asset managers, we've seen significant growth of passive investing and ETFs. There's been a lot of fee pressure on the buy side, which has resulted in, economies of scale and the growth of the very biggest asset managers quite significantly, and I guess towards a winner takes most type model. I think many of our contributors talked about a potential revival of active asset management over the next few years as sort of a degree of volatility returns to markets. So it'll be interesting to see sort of how that trend perhaps comes back. Then within the pension fund sector, the very largest pension funds have grown significantly, partly driven by demographic demand, obviously, as well. Mm-hmm. And then finally, in the hedge fund space, we've seen the growth of sort of multi-strategy, multi-manager funds that now that encompass sort of a number of portfolio managers within them, and their scale and sort of market impact and the overall power of the buy side, I think, is significantly greater than it was in 2015. And again, I think that trend is expected to have some longevity.
That's interesting. I think that aligns with some of the themes we've seen, particularly around the cost of doing business with the greater reliance on tech and the need for economies of scale at various other levels. The need to have size of the buy side to be able to remain efficient. So I think that's interesting. I think we'd agree that is something we'd probably continue to see happening in the future. Then I think the other big topic that you pull out is on private credit. And it'd be really great to hear your views as to what the FMSB thinks is going to happen to that in the sort of next decade.
Yeah. So again, I mean, everything I'm saying is based on the input that we receive from our contributors. And I said on sort of the one side, the traditional bank model is being challenged by the proprietary trading firms, and on the other side, you've seen significant growth of private markets and private credit in particular recently. And again, this is in part driven by the regulatory framework and the prudential rules that exist. But I think many of the contributors that we spoke to expect there to be again longevity to this to the growth of private credit markets.
And do you think that distinction between private and public markets is something that's going to disappear a little bit?
Yeah. So again, I think. And this was actually a broader theme that came out within the paper, but around the blurring of boundaries, both within asset classes, between wholesale and retail, and then between public and private. And obviously, there is a push to getting more data on private markets. As retail money moves into private markets, there's also a push to get greater liquidity in private markets and more secondary market liquidity. And as you have more data, you potentially have more liquidity, you have a growing secondary market, sort of the fundamental features of a public market versus a private market perhaps do start to conflate or blur a bit.
Kind of stepping back, looking at that theme around market participation, there really is like a lot in there. And it feels like the markets already look very different to where they were 10 years ago. So then predicting what they look like in another 10 years, it sort of feels like you've got more equality of scale between buy and sell side. You've got a slight breakdown between public-private markets, and you've got kind of tech-driven support to make trading and liquidity slightly more efficient to potentially open to retail. That, to me, feels like a very different world to what I grew up in and what people are traditionally used to. Do you think there are any disadvantages of that?
Look, I think it's interesting because one participant said to me, usually we overestimate change in the short run and we sort of underestimate it in the long run. I think clearly predicting what's going to happen 10 years out is very, very challenging, and it is very much informed by the themes of the last decade. I think, look, there may be issues that arise in relation to transparency, for example, in private markets. to ensuring that the growth of new participants in markets are subject to consistent standards. So there is a consistency of treatment across similar activity types. The lessons that were hard learned, I guess, over post GFC and within the traditional dealer model, that they are continued to be applied and considered in sort of new contexts.
And then I think we'll go and have a look at the next theme that comes out of the report. And this one could be seen as a little bit more niche because it focuses on changes to the trade execution environment. But I think it's important to remember that kind of trade execution is pretty fundamental to the efficiency of markets, and minimizing that has all sorts of benefits for market participants kind of across the value chain. So actually, whilst niche, it probably drives or probably has a relatively large impact upon efficiency and returns. So I mean, what do you see happening to trade execution, and what are some of the big themes that are recurring?
Yeah, so within that space, again, and this ties to market participation to some extent, but we've obviously seen massive electronification of wholesale markets. Initially, I guess, in equities and FX, but that's the electronification of fixed income has significantly grown. I think there will remain a role for voice for large, complex, bespoke transactions, but the penetration of electronic trading is expected to go further. Whilst we're at very early stages now, AI will likely start playing over the next few years a more significant role in trade execution, and lots of this is driven by cost pressures and seeking to minimize the cost of trade execution, and to do so in the most efficient manner possible.
Great. So it's effectively a continuation of those existing trends.
The other element, actually, Seb, that I was going to come on to was in terms of sort of where execution takes place. Again, we had perhaps a decade or so sort of very much a dealer-to-client model, and in part driven by some of the regulatory changes. Lots of that activity has gone on to venue, and so the role of venues has become much more central. The role of data has become much more important in markets. It'll be interesting to see sort of how that trend plays out, and whether we start seeing a return of more liquidity provider to client connectivity through direct streaming and other sort of alternatives to competitive RFQ on venue execution.
The third theme that the report identifies is the growth of new asset classes. And I don't think there's any surprises in what it identifies as some of the future trends, because we've been talking about a lot of these already. And in particular, the report talks about cryptocurrencies and stablecoins. Based on the discussion with your members, what does the FMSB identify as some of the key kind of drivers or risks around those assets?
Yes, as you say, sort of what we describe as new asset class frontiers in the paper have developed, and we've seen both the growth of traditional FIC instruments, so massive growth in sovereign debt markets over the last decade for various reasons, COVID, stimulus, other things, corresponding growth in FX, and then, as you say, these new asset classes that have emerged, both unbacked crypto and backed instruments like stablecoins. And interestingly, I think in the discussions that we had when producing this paper, there was a significant focus on stablecoins in particular, and the role of stablecoins and the increasing interconnectedness potentially between the traditional financial system and the stablecoin market. And so, to take one example, I understand that one of the biggest stablecoin issuers now holds more US Treasuries than Germany does, and could potentially, the overall stablecoin issuer population could end up being the second biggest holder of US Treasuries. And so suddenly you create this significant sort of interconnection between a stablecoin market and US debt markets. And clearly at the moment, the stablecoin market is very much it's US dollar denominated market, but we will start probably seeing the development of that in other jurisdictions, and there are concerns that have been expressed at central bank and other levels around sort of the privatization of money, the risk of deposit flight from banks, particularly if stablecoins were able to pay interest on their holdings. So this is clearly both from a policymaker perspective and also from sort of a practitioner perspective, a very sort of significant area of focus and potential opportunity and also risk.
Yeah. So we've certainly had conversation with regulators, including Treasury here, about those macro risks as and when you end up having very significant amounts of treasuries potentially being sold into the market in times of stress. And certainly they are looking at how to best manage that as part of the developing UK regime. Thinking about crypto and stablecoins, these are global regimes. Any appetite for the FMSB to start making any global standards in this space?
So look, the purpose of this report was to think about what have been the key thematic changes in markets over the last decade, and then to start looking forward as to where, what are the key trends. And we need to think about who are the key participants in the market? Who do we need to have at the table in addition to our existing banking members and asset management members and corporate members? We will then determine the topics of focus, in light of potential future risk to fair and effectiveness of markets. And clearly, if stablecoins continue on the trajectory that they're currently on, they will in the future have quite a significant role in markets, and we will need to consider what we would do as a standard-setting body in response.
And then staying on new asset classes for a moment, the report also talks about a related topic, and that's the growth of DLTs, distributed ledger technology. And again, we've been talking about these for a while, and I think from our perspective, we've seen these start to get rolled out. But do you think we've seen these really start to kind of show their colours yet, and is there much room for them to continue to grow?
So I think this was an area where certainly we heard a diversity of opinions from experts. As you say, there's been a lot of discussion and a lot of promise associated with DLT technology and sort of tokenization of both existing assets and new or native assets. We heard varying views as to the likely speed of adoption. I still think it sounds as if we're in relatively early stage and that some of the initiatives to date have been more proof of concept and testing rather than sort of truly scalable. There are potentially very significant back office savings associated with the use of DLT and tokenization. I think the efficiencies that can be derived from it may well mean that longer term, the market does shift very much onto DLT technology. But there are barriers. There are barriers to doing that in the short term. It's a very significant investment in the short term, even though that may yield significant savings in the longer term. So I think probably, whilst we heard a variety of views, I think the majority perspective was long term. This is likely to have significant changes, but I wouldn't overestimate necessarily the impact in the short term.
Turning to the last theme identified in the report, which is geography. And in particular, this looks at the interplay between some of the traditional financial hubs, such as London and New York, as well as against some of the newer regional hubs, such as Dubai, Abu Dhabi, Hong Kong, and Singapore. We're currently recording this in the middle of the City of London. Do you think this is still the right place for us to be recording a podcast about financial markets? Is it going to stay that way?
London and New York, as we say in the paper, remain key financial centres. New York is obviously the centre of, in equity markets and private capital and other things. London remains, based on, the Bank of International Settlement report, very much a key player in the interest rate market, in the FX market. So, the role of these traditional financial centres, I think, will continue to be central. That said, I think there is a view that we are heading into a world, and this is linked to sort of the geopolitics as well, but of greater regionalization and the growing role of regional hubs. And as you say, the role of hubs in the Middle East, Abu Dhabi and Dubai in particular, the role of Hong Kong and Singapore. And I guess also within Europe, we've seen some trading and other activities shift to jurisdictions like France. So there's a little bit more fragmentation also within a European context. So London, New York, I think the view is will continue to be key centres, but we will see we're likely to see greater fragmentation and more regionalisation of markets in the coming years.
And is regulatory arbitrage like a large part of that, do you think?
Well, certainly, as we sort of touched on before, post-GFC, a great effort was made to drive consistent international standards through the G20 and other the FSB and IOSCO and other mechanisms. I think there is some concern that we may start seeing more regulatory fragmentation and a bit more of a patchwork approach across jurisdictions, in part driven by competitiveness and growth agendas. And a desire to attract business to your jurisdiction.
And I suppose coupled with increases in technology and ease of trading cross-border, it sounds like to me that there is some scope for there to be a bit more rivalry between financial centres and not necessarily looking to serve their own immediate population, but actually looking to do so on more of a kind of cross-border international basis.
Look, I think the shift to regional hubs is certainly underway, and London and New York have had very privileged roles in global finance, and no doubt other jurisdictions would like to have more activity happening and to be facilitating more international finance activity in their hubs.
So it sounds like London is here to stay for a while longer, but there could be a little bit more competition around the edges.
I hope so.
Good. They're the main themes in the report. Any other interesting points that you'd like to pull out, do you think people should be aware of?
I think two themes that it's worth touching on. One is around the increasing interconnectedness of different aspects of the system. So to take private credit as an example, we're seeing increasing joint ventures between banks and private credit firms. In other areas there, as we mentioned before, in the stablecoin space, we have connection between stablecoin issuers and traditional markets through the US Treasury market, for example. And so there are various areas where we're seeing interconnectedness between different segments of the market, and also between sort of traditional financial markets and sort of DeFi. And again, the crypto space is an example of that, as the traditional dealers start providing services in relation to the trading of certain crypto instruments as well, which may well grow over the next few years.
Yeah, and I think we'd agree in terms of seeing that maturation of the crypto markets to become much more palatable to kind of traditional financial institutions is certainly a bit of convergence of old and new.
And the other trend, Seb, I think that just to highlight is around blurring of lines between wholesale and retail participation. And technology is obviously enabling greater retail participation into new asset classes. Again, the private credit space is an example of that. So I think sort of perhaps in the past we had a very clear delineation between retail markets and products that were accessible to retail and institutional markets. And I think based on some of the input that we were getting and the democratization of access to financial products, those boundaries between what is an institutional market and what is a retail market may blur.
And that's interesting. Other than telling our clients that they certainly should sit down and read this report, is there anything else you think we should be telling our clients here at Skadden?
So I think, look, we mentioned before that perhaps we've reached a sort of a high cyclical watermark for regulation. Regulators and policymakers still want to ensure good outcomes for users of wholesale, users of markets. And I think as we may see, regulators simplifying their rule books or in some instances slightly reducing them, and also to the point before around competition between regulators and between jurisdictions, I think we're likely to see the role of standards become more important in that landscape. And clearly, to the extent possible, having consistent standards for for activity across jurisdictions is beneficial both to the, your clients who are service providers and also your clients as users of these markets. So we're seeking to work more closely with regulators in various jurisdictions. We're a member of IOSCO now, in order to, where possible, drive consistent standards of conduct across to drive consistent standards of conduct across international financial centres.
So effectively there's an opportunity here. If we continue to see some deregulation, now that isn't necessarily licensed to operate in a new Wild West, and actually the importance of lighter touch standards to drive conduct is going to become increasingly relevant?
I think that's a possibility, yes.
Great. That's super interesting. I think that brings us to time, other than just to say we've skipped through an enormous amount of topics here, and I think there's some fantastic themes coming out of all of this. So certainly kind of asset classes, tech, geography, all feel like things that people are going to have to continue to look at over the next kind of few years. And actually there sounds like there could be some material changes in 10 years' time to what we're looking at now in terms of how people trade and interact with those markets. I also think that just leaves me to say, Chris, thank you very much for being so generous with your time and coming in today. And I hope to speak with you soon.
Thank you, Seb. Delighted to be here.
Thank you for joining us for today's episode of The Capital Ratio. If you like what you're hearing, be sure to subscribe in your favorite podcast app so you don't miss any future conversations. Additional information about Skadden can be found at skadden.com.